Yeah, we're good. Okay, cool. And everyone can hear everything. I saw that Brian said he wants to see Joel's mustache, so we must be good there. All right. Thank you all for coming in person. I always love seeing faces in person more than online, so thanks for coming. By the way, somebody said that they want to see your mustache. Cool. Cool. Thanks again for coming, guys. Just so you know, we have a very diverse group of people that have been interested in learning more about like middle housing and this specific financing. We've got property owners, we've got lenders, both bankers, private capital. We've got some architects, we've got some civil engineers. They're all kind of looking at this to figure it out. There's a lot going on. So just so you know, there's a lot to unpack in here. And don't hesitate to raise your hand if you've got questions, because I would like to have them kind of while we're going through the slides rather than at the very end. You might forget, and I don't want you to feel like a lot of pressure. So there's a lot to cover here. It's a really dry subject for those who don't do financing, so just be aware. All right. Also, we're going to do a little bit of a recap from the last few months. We're going to roll things from previous months into the next month, so people who didn't come last month can see what's going on this month. And what we kind of talked about previously. And we're using a few property owners' properties and projects we're working on as case studies. So you can kind of see it if you're following along month to month, since it's a 12-month series, kind of how the full deal's coming together from, our initial feasibility findings to how we're structuring the deal, how many units we're putting on there. Now this will be talking about financing. Also, we didn't provide financing options for all the different types out there, because it would just be way too much and it'd get really complicated. Also, we're not looking at it from like a builder's perspective for what we're going to show you, because there are people that want to acquire property. There's people that already own property. Some people have a low loan on their land. Some people have no loan on their land. The returns, how the deal performs is going to be very different at very different stages and who you are. So we're just trying to kind of appeal to a lot of different type of people. So just keep that in mind as we're going through things. So this month is Show Me the Money, more about financing, debt, equity, partnerships, stuff like that. Oh. See if this works. I don't know why that's not working. Okay. Maybe this isn't on. There we go. Okay. Cool. All right. So first off, thanks to Master Builders. If you're not a member and you build, you should be a member. Scan here, because they are great. They're letting us use their space for free. I'm a member personally. They provide great benefits. They do a lot of advocacy for everyone. There's a lot of stuff changing out there with permit fee increases, just all the new codes that are going through. They do a lot of good work out there for us as builders. So if you're not a member, check them out. This is our 12-month series. We've already talked about introduction to middle housing, opportunities. We're talking about financing this month. Next month, we're talking about navigating zoning and permitting. If you want to sign up for that one, we do have some flyers at the front, which you can grab to sign up for the next month. I know that it's around the holidays. It's going to be tough, and not everyone can make it in person. We do have it on Zoom. I know there's quite a few people on Zoom as well. And I think in some cases, we have some city officials on Zoom too. So I'm trying to watch my mouth a little bit. Okay. So recap of the last couple meetings. What's changed? We got House Bill 1110 and 1337. Those went into effect in June of 25. That allows for you to add more density. I don't want to get into too much of that because you got different tiers based off population, what you can do, what you can't do. But if we are actually putting all of these recorded on YouTube too. So if you guys want to go back and look at anything, or you want slide decks after the fact, you can always just reach out and ask. But that's what we covered in the last couple of meetings. Just real quick on House Bill 1110, it allows for duplexes, triplexes, fourplexes, fives, sixes, courtyard apartments, cottages, townhomes, stacked flats. The ones that really don't make sense are the stacked flats and the courtyard apartments for like the middle housing types. Just the cost of construction, land values, everything. It's tough. And really, fourplexes, triplexes, fives, dupes. These are all townhomes basically, however you want to look at it, but kind of all the same. House Bill 1337 allows for attached, detached, over garages, ADUs, DADUs, things like that. If you don't know what an ADU or a DADU is, it's an accessory dwelling unit. an attached one is an AADU, a DADU is a detached accessory dwelling unit. I'm keeping this one rolling every month because it really shows how everyone, I think, that is making the decisions about zoning are just focused on zoning. They're not really looking underneath the layer of how the zoning affects everything else, right? Fire code, parking, tree code, public work standards, not to mention impact fees, affordable housing fees, just all the stuff that goes along with it. I think that we've done a really good job focusing on zoning and adding more density, but we haven't really, well, we, as in the city and the state, haven't really focused on how that's going to be affecting all these other things below the layer. So I'm going to keep that one rolling. This is a little disclaimer. I'm not a lender. There are lenders in here. If somebody needs a loan, talk to a lender. Okay, different types of financing. You got debt and you got interest. So banks are going to be, one tier structure. I'll go over that. You got bridge loans, construction loans, land loans. They are different, but they're kind of, I guess bridge loans, land loans are kind of the same, but different depending on who you're working with. You got HELOCs, private capital, hard money, mezzanine financing. That one a lot of people don't know about. Equity partnerships, preferred returns, profit splits, and private equity. We're going to go into a little bit about all of those, and it might get kind of confusing. So again, if you have questions, make sure you raise a hand. Okay, so most construction lenders or banks or any of the like look at loan to cost and loan to value. Typically, if you look at like your total cost of the project, your loan to cost is going to be the whole percentage. And if you, let's say banks will be like 15% loan to cost. Some will be 80, some will be 75, just depends on who you're working with. And what that means, if you take the total cost of the project, that's land, interest reserves if you have them, soft costs, hard costs, everything. That difference of 100%, so if it's 75% loan to cost or if it's 85% loan to cost, that difference is 15% or 25% down, which would mean, like, let's just think about it simply. You go buy a house for $1 million, you got to put 20% down, you're putting $200,000 down, right? So you look at the total cost of the project with everything included and the LTC, which they require because everyone has a little bit of a different metric, but generally 85% would mean you got to put 15% down to the total project cost. Loan to value, that's just what it is, right? Your loan to the value of the future units that are be built. Typically 65 to 70%. Lenders don't want to go over 70%. So if that's the case, they'll make you bring in more equity. Your LTC may be lower, but if your LTV is higher, they'll make you bring in more cash. So it can be confusing, but the bank is always going to look at. Soft costs, hard costs. If you don't know what these are, hard costs are your sticks and bricks. Your vertical costs, think about like your framing, your roofing, like all of your concrete, everything you got to put in the ground or in the air. Your soft costs are all your paper, like your permits and your engineer drawings and all the other stuff that goes along with it to be able to get to approval to be able to build with your hard costs. Okay, this is actually a pretty cool slide. Shows all the different types of debt loans that you can have and all of the different types of equity structures that you can go into. We're going to get into a little bit of that. And these will be coupled together a lot of times. So like you could cross, a hard money loan with a partnership, or you could do a private debt and you could collateralize some, other property you have, or you could maybe pull out a HELOC from your existing property to pay for soft costs. And then I don't know, I guess this wouldn't account for it, but you could do, because that's kind of equity at the same time. But depending on if you do a HELOC and actually it's a loan, it's a loan and then you get another loan. So anyways, I guess what I'm saying is like there's a lot of different ways that you can structure a deal with all the different types of financing that you have. And everyone's got a little bit of a different points, rate, loan terms, floating, locked, like all of that. What does that mean? We're going to get into all of that. Okay, so debt loans. And I guess if Ben or Katie, if anyone has a question on Zoom, since I can't see it, will you just let me know? Okay. All right, bank loans. So if you think about, I'm going to name some names, and I'm not naming this derogatory or in a positive way, but just some people have different structures of different loan types that you do. And they're going to, they're not typically like a bank that maybe lends out for construction. They're more of like a traditional bank. Like think about like, you put your deposits in there for your typical stuff that you get a paycheck, you put it in there and whatnot. Those banks are going to require a lot more equity. They're going to also be a little bit more conservative on their numbers. They're probably also going to take a little bit longer on your draws. If you don't know what a draw is, it's when you request for the cash to be able to then pay for your subcontractors and suppliers and GC. They're probably going to have a third-party inspector that's going to look very closely over everything that you're requesting funds for and then ask for backup. And so that's not bad. What they're doing is they're covering their bases and they're just a little risk averse, and that's fine. But they'll probably also have a lower interest rate, which is good. So it just kind of depends on what's more valuable to the borrower. Do you want to have a lower interest rate, or do you want to have maybe a little bit of a higher interest rate, but have more of an accelerated timeline through the process, which shortens your project, right? Because the quicker that you can get your cash, the quicker you can pay your subs and suppliers, the quicker you can get through the project. And if you, for example, are working with a lender and you submit your draw, let's call it for 250 grand, and then they have a third-party inspector that goes out and says, hey, I'm only going to give you 200 because I don't agree with some of these other things that you have here you're requesting cash for. And then you can then only pay your subs and suppliers that 200 and you're waiting for the 50, you're pulling that 50 out of your pocket. Or you're having to not pay those people. And then those people that are, on your job are not going to want to work for you because they're not getting paid in a timely manner because they got to pay their people.
You know where my headphones are? My corded ones?
I don't know where your headphones are. So anyways, that's bank loans. So yeah, that's kind of what I was talking about as far as like the lender, the loan to cost, loan to value, the amount of equity they have down, slower draws. Not all banks are like that. There's some banks that are more kind of non-traditional lenders as far as like banks go, but they kind of know the construction process. They're in the Pacific Northwest. They work with a good tight group of builders. This is their business. They have a whole department for that. They're quick on the draws. Those are really good, lenders to work with. But there's just different ones that have different strokes for different folks, right? Again, those will be probably a little bit more on the interest, less on the interest, but slower. A lot of what they, factor in their cost of their interest rate is based off prime or SOFR, depending on which one they go with. So prime plus 1%, prime plus 1.5%. If you ask what prime is now, I think it's what is it, like 6.5%, something like that. So 6.5%, maybe 7%. So they'd be at like 8.5, maybe 9, depending. Or 7 plus 1 or 7 plus 1.5. Is it 7? Okay, so you're at 8. And so like if you're prime plus 1% and you're 8% rate, that's pretty good if you look at it compared to some others. However, if you're working with a bank, I don't know if I have this one on this slide or the different one. Yeah, right here. You have to, so their banks are going to require typically 10% of the assets and liquidity to the dollars loaned. So what does that mean? Let's say you have, because we're in Bellevue on the east side, you've got 2 to 3 projects that you want to build. And you look at the total, it's like 4, let's just call it 4 cottages per. And then with the land and the interest reserves and the hard and soft costs and everything like that, it'll be like let's call it, just for easy math, $5 million loan for both. You've got 2 projects. That means you got $10 million in total, right? So you have to have 10% of that in liquidity readily available if you need it to be able to deploy if something is slower or they need it or something. So you got to have $1 million in cash in your pocket. It could be stocks, but it has to be readily available in liquidity to be able to use. Banks are going to require that. If you work with a private capital lender, they may not require that. They probably want some funds, but they're not going to require that specific amount. But their rates are going to be a little bit higher. So is this all kind of making sense? I know you're a lender though. Is anyone getting lost yet? No? Okay, good. All right. Don't be shy. All right. So, okay. So the previous one was a bank that does not do a lot of construction, 70 to 75% loan to cost, 30% down, 25% down equity. right? You're like, what does that mean in real dollars? If you got $1 million loan, you got to put down $250,000 to $300,000. Compound that for a Bellevue deal, be 900 grand. Let's call it $3 million or whatever. Bank lender that does a lot of construction loans, they're going to be 80 to 85% loan to cost. Typically 85%. That's kind of what I see usually. Sometimes they do third-party inspections. You still need to have 10% of assets. I think we don't want to focus too much on the rate per se, because there's points that are also involved there. And if you think about what does that mean, it's like, well, you've got to pay an origination fee. You've got to pay an interest rate over time. And you got to pay closing costs on top of that. And the other thing too is that some banks will allow for interest reserves and some will not. Interest reserves are basically just like, if you calculate the total cost of your project and it's going to take you 12 months to get through this portion of the loan, they allocate how much that is going to cost in a loan and they put it in a separate bucket, and they basically say, okay, every month we're just going to add to that bucket as your costs increase. We're going to say that you owe us this much back to pay off as the loan, right? You got to pay off your principal plus your interest, and we'll just stack that up. Rather than you cutting checks out of your pocket, they have an interest reserve on the side, which you can then draw from every month. Some allow that, some don't. A lot of banks do. So that's what those are. Private capital lender, these people, quick business purpose is mostly what they do. They're not a traditional like bank per se. A lot of them don't even do like primary residence type of loans because it's all business purpose. Really quick on the draws. Sometimes they don't have third-party inspections. They don't require 10% of the assets to liquidity. They're going to look at your experience. They're going to look at how many deals you've done. They're going to look at what other, what you have in your WIP. I guess we don't have a spot for that in there, but WIP is your like work in progress. How many deals you got going? Do you have the capacity to be able to actually take this deal down? Are you a good borrower? Because they want to get paid back, obviously. But their rates kind of depends, right, on who you're working with. Some of them go based off prime, and maybe it's prime plus 2, prime plus 2.5. Some of them, they just kind of have their own, they just make it up because, well, they don't make it up. They're getting funds from somebody else at a lower rate, and they have to redeploy that at a higher rate, and they have a spread that they got to make. So it really depends. It's private capital for a reason. It's not managed by the FDIC. They maybe have like a fund that they've got to report to, and kind of like, what do they got that they're working through on the loans, but very different than somebody who's working with the FDIC. Also, the loans are shorter term, 6 months, 24 months, maybe 12 months. Just kind of depends. Bridge loans, construction loans, rehab loans. That's mostly what they do. Hard money lender. These guys get a bad rep sometimes, but a lot of them are just, flip loans. And there's nothing wrong with that. But they're quicker turns, so they can charge a little bit more. You're like in and out of a flip in like 4 to 6 months. So requires less cash down. You can do 90% LTC, which means you're putting 10% cash down. That's pretty good. Just depends. Like that just means you're leveraging a lot more and you're putting less equity down. It's a little bit more risk for the hard money lender, but they also have a higher rate and points to be able to manage that risk. That they know the business they're getting into, but they're going to look into the person they're working with to make sure that they feel okay taking that risk. But again, if you're doing like a 4 to 6 month flip in and out, then, it's going to be a little easier than working with a big bank, and it'll be quicker because like in this case, definitely time is money. All right. So bridge loans, construction loans, HELOCs, bridge loan. Okay. Bridge loans are bridging the gap between buying the property and your construction loan. So that means that when you buy a piece of property, if you don't have permits in hand, you're either going to do a land loan or you're going to do a bridge loan. The bridge loan bridges the gap between when you acquire the property to when you get permits, which then you will roll to a construction loan. The construction loan will pay off the bridge loan, which is usually kind of factored into your pro forma. You got 2 different loans with 2 different sets of interest reserves or costs factored in. And this is the time where you're going to buy the property. Let's say you got a really good deal, and then you factored in the cost of the bridge loan, and the seller needed out of the property really quickly, but you got to be able to get permits. So you just factor all that in. Sometimes you can get interest reserves covered as a part of your loan, which means let's say you're taking down a piece of property and it's going to, be a 3-unit cottage deal, and you got to put the architecture in there, you got to put civil, permit fees, impact fees. You've got to pay your structural guy, you've got to do survey, you got your condo docs, like all of this stuff that you've got to factor in to be able to get to your permits. With some banks, not all, a lot of them don't do this, but with private guys, you can put your soft costs in as a reserve. So if you're saying like, I want to buy a piece of land for $1 million, it's going to cost me 250 grand to be able to get permits in hand with all the permit fees and everything else. Then they'll give you a loan for 1.25 plus your interest reserves. And then you can close on that land, and then you can get a draw schedule that says I need to pay my architect and my surveyor and all these other people along the way to be able to get to the point where I can get permits ready to issue. And so I'll kind of show all this at the very end so you can kind of see it in a pro forma format, but this is what a bridge loan really is. It helps you get to the point where you're ready to actually put a shovel in the ground. Typically it's 12 months or less. If it goes more than that, you can get an extension. Sometimes they cost fees, sometimes they don't, but it's really good to make sure, like, when you're closing a deal and you're working with a lender, you're basically presenting a business plan. This is how long it's going to take. This is how much it's going to cost. This is the reason why. This is what I want to do. This is what it's going to sell for, right? So here's some advantages and disadvantages of a bridge loan. I will say right now, if you guys are looking at acquiring property based off where the market's at, you can get a lot more people that are willing to do longer closes. Because if you're factoring in, like, for example, if I was to go to a property owner right now and say, hey, I want to buy your property for $1 million. And they're like, well, I want 1.3. And I'm going to say, well, I can't give you 1.3. But if I was to close on permits, I could give you 1.275. And they go, okay, well, I could do that. So it's like a 12-month close, and we're close to 1.3. They get an extra, money in their pocket, but it's because I don't have to pay the cost of the bridge loan all the way, right? So I guess, well, the advantage of that is that you have speed, right? The disadvantage is that you just continue to increase costs. And then if you're dealing with the city and you're trying to get permits, maybe your permits take 14 months instead of 12, or maybe it takes 16. It depends on where you're working. But the disadvantage is that you're stacking up more costs on your project. It's a little bit more unpredictable. Whereas if you say, I want to close with the property owner with permits in hand, you have a little bit more, you got some more cards you can play. All right, so construction loans, typically short term, depending on the size and the structure of the deal, they're 12 months. They're usually 12, 16, or 24 months, depending on the size, scope, location, multifamily, single family, whatever. But your interest reserves, your total cost, kind of your LTC, your LTV, that's all going to be factored into how long this construction project's going to take. And your construction loan is also going to factor in the time that it takes to sell out of the project. So let's just say, I'm going to do a 3-unit cottage deal here in Bellevue. I'm going to close on permits. I'm going to have permits in hand. I need to close on that loan. It's going to take me 9 months to build out that project. I have an additional 3 months, but it takes 30 days to close on a home. So I need to be able to put it on the market. And then maybe it takes a couple of weeks, maybe a month to be able to find that buyer to be able to then buy that loan down till you get through all of them. So typically you want to have the months for your construction loan to be actually longer than the project takes, because you got to factor in the time that takes to sell out of the deal. Interest reserves, we kind of already talked about. If you can, like this, the one thing that's really good about this is that you can scale more when you don't have to pay out of pocket interest reserves. Like, let's just say I was doing like 3 flips, which I don't do flips, but let's just say I was, and I bought all of them for $1 million. And then I got to pay for all of the costs to do the flip. And then I got to pay for interest on that loan every single time too, right? You're either maybe going to have a good investor in your back pocket that's going to give you some cash that you can then pay those, or you're paying it out of your own pocket. If you have interest reserves, they basically are just allowing you to stack that up against the total payoff down the road, but I can then be a little bit more frugal with the cash I'm spending. So it just allows for you to scale a little bit more. Okay, home equity line of credit. So this is interesting because we have a couple property owners that we spoke with recently, and they own their land free and clear. And because they own their land free and clear, when we get to the very end, I'll show you a pro forma for a guy who owns his land free and clear. And he came to us and he says, I want to do something. And I said, okay, it was gonna be like $900,000 of cash that he had to bring into the deal, but his property value is worth 1.75, I think is what it was, 1.75. And, with a HELOC, you're able to take up to 80% of the value out, maybe 75, depending on the lender you're gonna do the HELOC with. And so because his value of his existing house property was worth 1.75, and we only needed to take out 900 grand, you don't have to pull any cash out of your pocket to actually do that deal because you got so much cash in your property. It's like it's untapped equity that you can then utilize. So then this home that was going to sell on the market or to a builder for 1.75, he's able to create almost like $3.4 million out of that. And he's not having to pull any money out of his pocket. I'll show you guys how that works. So if this is kind of an interesting play to be able to kind of have you do deals with no money down. And this is also, like, again, for a property owner who has a lot of equity, not necessarily a builder that's going and acquiring a piece of property to go build a cottage project. The capital we kind of talked about a little bit already. Yeah, less regulation, not a bank, not as heavily regulated, really flexible, fast, relationship lenders, basically. Mezzanine financing. So this is for some bigger projects, mezzanine financing. Like, what it is basically is, okay, so you're gonna go close on a loan. Let's say you go buy a house. You're gonna live in there. That's a first position lender. Let's just make it really simple. I'm gonna go buy this house and I'm gonna live in there. That lender is in first position. If you want to get mezzanine financing for something that you want to do for business purpose reasons, and you're going to create a return out of it, they're going to be in second position behind the first. Meaning, let's go back to the 3-unit cottage deal, for example. Okay, I bought this property, I got a loan from a bank, and it's prime plus 1.5, got to pay some points, that's all good. And I need like, let's just call it $700,000 in equity. Well, if I don't have $700,000 in equity, and that lender that gave me that loan to be able to close on that deal is probably not a bank, it's probably private. But another person, private investor, or a fund could give you mezzanine financing, which means that they're going to record a note in second position behind a first position loan, and they're going to take an interest on the capital that they've lent to you and profit split, typically. It could be interest and profit or just profit, but a lot of times it's interest and profit. And they'll, again, accrue that over time. So let's say Tyler gave me 500 grand. Tyler gives me 500 grand. He says, I want 8% interest on my capital. And I also want 25% of the profit split. That's basically what it is. So let's just say you were to make $1 million. Then you're going to have to give up 8% for however long that cash has been kind of used in that deal. And you're going to have to give up 25% of the profit. Now, if you don't have a lot of cash of your own to be able to do a deal, it's a good way to do it in a good market. If it's not a good market and it's kind of, you could chew away a lot of the profit really quick. So just something to think about. Also, if it's second position note behind the first, you have to make sure that they're cleared off of title every time that you close a unit, which then kind of makes like the selling process a little more complicated. So second position. Yeah, pros and cons. Can less dilutive of the equity, higher cost. You can lose some control depending on who the fund is that you're working with. Yeah. Yeah, no, good. Go ahead. Yeah.
Vacant piece of land, and how you mentioned a HELOC, but that doesn't seem too standard, my understanding.
Okay. Well, it depends. I mean, like, we've got lenders that said, hey, if you've got this land free and clear, you want to put 4 cottages on it or something like that, and your margin on that deal is 25 to 30%, your loan to value is going to be so low. If you want to be somewhere between 65 to 70% loan to value, but because you have all this equity and you don't have to acquire that property because you're the property owner wanting to do that deal, your loan to value is at like 50%, right? Even after you pull that HELOC cash out, they'll do that deal all day. Does that make sense?
Yeah, I mean, it totally makes sense. I hadn't used for HELOCs not in the same sentence as so that's first time.
Yeah, well, it just depends on the lender you work with. I mean, you could go to BECU and you can get a HELOC. or you go to a private lender and they'll give you a HELOC. It just depends on who you're working with and how you're using it and what the goal is and how they're getting paid back. So that's why it's like kind of really important to know like all the different structures and like all the different types of lenders and really what your business purpose goal is and making sure you're working with the right people, because some people could really gum it up. Yep. Okay, private equity partnerships. So private equity partnerships are kind of like a mezz loan, but not. They're not in second position behind a first a lot of times. So like if you wanted to go develop, let's just say this vacant lot you're talking about, you wanted to go develop it and you, let's say you have like an existing loan on it that's 800 grand and it's worth 1.2. You don't really have enough cash to be able to pull out of that. So you need to bring somebody in or you got to bring some cash of your own in. So you could bring in a partner, which would be like, hey, buddy of mine, I need 500 grand and I'll pay you an interest and I'll pay you a profit split and I'll put together this LLC and we'll fund the deal after I get permits and everything like that. And basically that will make our LTC and LTV where it should be per the lender. And after we close out of this whole project, I'll pay you a profit or an interest on your money. That's kind of what that is. It's not in second position a lot of times, or it's not a secured note. It could be. But it'll be a person who is contributing to an LLC for a business purpose project. And typically they're all individual. So, man, I wish I had a whiteboard because it could get kind of complicated. Let's say you have like this project over here, this one over here, and this one over here, and they're all different deals and you've got different investors in each one. You're going to make sure you got different LLCs. And if you've got different investors in each one, you want to make sure that the books, the loan, the investors, everything are completely separate, and they'll be members of the LLC for that specific deal. And then they're going to get, at the end of the project, a return and a profit split, which then, we typically see like 20 to 25% annualized return, which means there'll be 40 to 50% return in 2 years. That's kind of what we typically aim for. Does that kind of make sense? Okay, preferred returns we talked about, profit splits. Yeah. So
when you are speaking to that, are you saying that the private partnership money, private equity partnership, do they sign on the debt?
No, they don't.
Yeah.
Their risk is the capital they put in. You could do it that way. Let's
Well,
I
we
mean,
try to structure deals where allow that capital source to not be, part of any potential terrible scenario.
Yep.
So that if it all goes in the wrong direction, they're at least not, owing a whole bunch of debt.
Yeah.
Type of situation.
Sure.
So like you try to structure those deals where you find somebody where they lean on you to get the debt, being the developer, borrower, and are protected from that downside.
Yep, for sure. Yeah, but I think you also know too that like what is it, 20%? If you're 20% or more of the equity that gets brought in or whatever, then they would have to sign on the debt unless I agree that they don't have to, right?
As well as you can do it where if the person's like wanting more, you could do a operating agreement, profit sharing arrangement. Again, it's always good. I think the main point is that it's always good if you're using this, that the capital source you're trying to bring in is untangled from the debt as much as possible.
Right.
So that they're protected in the case of the nuclear scenario.
Totally. Yeah. Well, because like everything's got a personal guarantee, right? And we want to keep
them off of that.
Right.
That they feel like they're putting up some real money, but
sure.
That's the worst thing that could happen to this whole thing, that completely goes to zero, but they don't actually have to be putting even more money in a bad situation.
Right. Yep. Yeah, it's good money after bad money. Right. Yep. Okay, creative financing. This one this is actually a really sad story. Does anyone know who Martin Seelig is? You guys been watching what's going on with like, man, I feel so bad. Like that guy built the Columbia Tower. I don't know him personally, but like I'm just watching all of this from afar, and I'm just like, man, how does that even happen? So I started doing some research into it, and he basically cross-collateralized a lot of his stuff together, and then all of it started to fall apart. I mean, COVID happens, people left the office space, multifamily, all this. He doesn't, it's high vacancy. He's got cash he's got to pay. He doesn't have it. So then it's basically what cross collateralization is, or collateralization, however you want to call it, is like, okay, I have this property over here, which has a lot of equity, and I want to do this deal over here. It's kind of like the HELOC scenario, but you're like, I'm going to pull this cash out of this and put it over here, and I'm going to have a note against it. So that way I can do this deal with any cash out of pocket because I'm using the equity. And if everything works out good, it's good and it gets all paid off and you don't have to worry about it. But if it doesn't, then you're having to like sell this deal to be able to pay off this lender over here. And if you do that over here and over here and over here, I mean, like it's a domino effect. So,
You have to sell it off at 50%.
yep. Yeah, exactly. Yeah. So like you got to be really careful, but this is another way that you could do some sort of creative financing structures, is you could cross up one of your other assets to be able to allow you to do some deals on some others. I don't personally think it's a good idea. I think you keep everything very much at its kind of where it's at. If you're pulling out a HELOC for that one lot, it's on that one deal. It's not you're pulling cash out of this to be able to do it on another one, right? So, but it is an option and you could do it. And in a good market, it's a way you can do some deals without having to pull a lot of money out. Okay, partial releases of property. So we are working on some of this. We talked about this last month. This is really interesting, I think. Yeah. So like we're working with a property owner right now where he's got this non-conforming existing house, which he's actually got a duplex. It's a duplex because it's top bottom. Basically, you've got like kind of the split level option. You got a little bit of grade slope here. This existing house, basically, he's got the whole top half rented. You've got a little walking path down here. You got a whole bottom half. So it's a non-conforming duplex. But either way, he's renting it out to 2 different people. He's been doing it for a long time. And he's got like a loan of 3.5% on it. But that loan is encumbering this whole piece of property right here. And it's a big piece of property. And like his house is positioned well on the side to where he can do something with this other half. But if you were to say, I want to go build these homes here, then you would have to remove your 3.5% rate because a new construction loan is going to encumber this whole piece of property, which means that depending on who the lender is you use, your 3.5% rate went to like an 8 or a 10 or whatever. It's a lot more than 3.5%, that's for sure. And so what you can do is you can get a survey of your property. You can have the bank do an appraisal of the property with this existing asset. You can then request that they release this portion from their loan because your LTV is still low enough, meaning there's enough value in this asset to keep the rate where it's at. And then this whole portion of the property will be unencumbered. You won't have a loan on it anymore. It's like free and clear land, if you will. And then you can get a separate loan at a different rate to be able to do this deal while still keeping your 3.5% mortgage on this one. So that's an example of a partial release of your property from the lender. It's just, you got to make sure you got the loan to value. You got to make sure that you do your appraisal. You got a survey. There's like a lot of steps.
Doing that without creating a loan.
Well, what we would do, like in this case, what we're doing is we're condoing this portion right here. And so then you could short plat it, but it takes you like 2 years or a year and a half or however long. It's so long. But you basically just show them on your plan that it's going to be condoed and you've got the LTV to be able to do it. So they'll just kind of restructure the debt here by keeping the same rate, just by releasing this. So. Okay, so then this is where the case study that I was talking about that we'll get into. I talked about this one, I think, a while ago. There's this big portion of property here that he's got to dedicate. I guess for those that weren't here last month, like he's got this really big piece of property. I can't remember how big it is, but this is like 3,500 feet that he's got to dedicate to the city because the city is going to require him to do curb, gutter, and sidewalk through here. So like looking at property and making sure that you actually have the size of the property that you think you have. It's like really good information. But this guy owns his lot free and clear. This is the one I was telling you about. It's 1.75. You can put 6 homes on this lot. I'm gonna go back. You can do 6 homes like I was showing, or you could keep this existing house and you could put 2 cottages. You could be either street facing, you got one, maybe they share a driveway, or they are facing each other. You could rent them, you could sell them, whatever. But regardless, he's got a really big lot. Even if you got to get rid of this piece right here to the city, still got all this right here you could do something with. Or you could just scrape all of it, and then you could build 6 cottage-style homes. Pretty cool deal. This is kind of what the financials look like from a very high level. So obviously we've got a development services fee. This is for Liberty to get all the permits and entitlements. It's going to take a little bit of time. So that's our fee there. The hard costs are about $350 a foot. That seems kind of high depending on who you're talking to, but a project of that size, you're probably going to have to do some sort of detention. You're over 5,000 square feet of impervious surface. You're going to have to improve that whole curb gutter and sidewalk, and you need to have a little bit of fluff in there too. Soft costs, that's all your costs to be able to get to your permits. So your total cost of the project for your hard and soft is about $5 million. And then you've got your months of interest. There's a little bit of cost factored in here. It says 30 months here, but that's because we're adding a lot for permit timeline. I think the permit timeline we said was gonna be 16 months just because this jurisdiction is particularly tough. And then we're using some of his because he has so much value in his land because he doesn't have any loan on it. You can pull some cash against it to be able to go towards that deal. And so we've got some interest reserves kind of factored in there for that HELOC with that lender we're going to use, and then the construction loan. So this is your LTC and LTV, right? So his LTV is only 55%. Like that's really, really low. Like the low side for a lender is 65%. The high side is 70. They usually a lender typically won't go over 70, but he's basically 10% lower, which is huge. And so the amount of equity you bring in at 15% is typically whatever the loan to cost is. So you can kind of adjust this based off of what this metric needs to be, but he only has to pull out 900 grand out of his property, but it's valued at 1.75. So at 80% of that, he basically can pull out, 1.4. So he's got 500 grand still left in equity in that land. So after you factor in, the equity that's pulled out, his loan's 4.9. He's going to sell 6 houses, 1.5 each. It's still pretty conservative, actually. You got all your selling costs. I always see, this is really funny. You see people that are like talking online and they're like, yeah, I bought this flip and I put 150 grand into it. And then I sold it for $100,000 more, but they don't factor in like the excise tax or the title and escrow fees or the commissions or any of that stuff. So really they don't make that much, but we factor in all of that, right? So this is kind of the scenario where, okay, here's the loan payoff, here's the equity that's got to go back. So here's your total project cost, right? If this $900,000 was equity that was raised from a private party or a Mezz loan, you'd have to pay that back, right? So like he'd be making like 2.4 on that deal. But because that 900 grand is pulled out of his property and he doesn't have to have an equity partner, he's going to get that back in addition. It's paying himself back off. So he's actually going to make almost $3.4 million out of that deal, where the house was worth 1.75 if you were to put it on the market. So it's pretty crazy when you look at that. Obviously, there's risk that goes along with it. There's time. But that's a way that you can creatively work through some projects without having to pull cash out because you have a high equity. And because you're getting that equity back at the close, because you got to pay everything off at the very end, right? You're making a hell of a lot more. This is a kind of a waterfall structure, whereas if you were to, bring that 900 grand in from somebody else, you got to pay that back, right? It's factored in here, the total project cost, you got to pay that back. So he's still making 2.4. However, kind of like we talked about, so investor capital, maybe you bring in one tranche for 600 grand at the very beginning. They're going to be in for 30 months because they got to go through the whole project. And they want an 8% rate of return on the cash they bring in, and they want a profit split. And so their total return is going to be, what is it right here? It's 44% annualized return. They're going to be in for 30 months. Their total return on their equity is like 111. That is not a normal deal. That's just because these numbers look really good. Typically a builder's shooting for like a minimum of 10, but anywhere usually between 15 and 20. So this is abnormally high. You may bring in a second tranche of capital. Your total is 900 grand, right? But you bring in another at 300 because you got to roll from your bridge to construction. They also want the same rate of return. And so they're kind of a little bit less because they're in the deal a little bit longer because they don't have to go for 30 months, but still really good return. And then if he, let's say, was to bring in that investor, then at the end of the day, he'd be getting the 70% because he's giving 30% away to his investors. At 70%, he's only making like 1.65. So like when we're looking at projects with people, we look at what's the best return for the property owner. Where does it make sense and where doesn't it? If he's gonna be going through this whole process of developing and he doesn't own anything on his land, and he's bringing in 900 grand with investor capital, and he's got to pay a pref and a profit split on it, and at the end of the day, he's only left with 1.6, but his as-is value is 1.75, it doesn't make sense to do that deal. Why would you go through all that headache and that time? Right? So being able to use the equity in his lands to not work with an investor where you're going to get that money back, that's a way better deal. So anyways, in this is also if he was to build build 6, sell 5, and then keep 1 as a rental. He basically makes his money plus his equity, and then he gets a unit free and clear that he can rent out. And the really cool thing about this is that if you've got that unit free and clear, you can do a cost segregation study, you can depreciate the asset, you make money, plus you also are having a rental property, which then you rent out for maybe a year or 2. And you've got so much equity in this now that you can 1031 that up into maybe like a 10-unit deal over in like Spokane or something like that. Just kind of gives you a lot more like wealth creation opportunities that really were not available before. Questions? No? Okay. If you guys are curious about a property you have or somebody you're working with, you can scan the QR code and we'll get back to you. James in the back, he'll handle all that. Next month, we're going to be talking about permitting and zoning for middle housing. Same place, same time, different date. And that's it. What do you got? Thanks. What's up?
Question for you, on the partial release, Ryan, for the property book, is that something that the bank has to do?
No,
Okay.
they don't. It's not one that it depends on your loan type and not all lenders will do it. Yeah, so it really kind of depends on the type of loan you have and who your lender is. But a lot of those, they've packaged it up and sold it, and it's, Fannie, Freddie. So it just kind of depends who's servicing it. Cool. What's up?
You mentioned the kind of the heartache of requesting a $250,000 draw and only getting approved for 200 grand of it.
Mhm.
And so I figured I'd mention that the best way to avoid that is if you're having different bits and pieces of your project done by someone, and maybe you're going to have something covered up by, you're going to have something covered up by flooring, you're going to have something covered up by drywall, taking pictures of that throughout the whole process and then meeting the inspector out there so you can show them the work that's done that's been covered up and save you a lot of that.
For
that
sure.
issue.
Yeah. And I even know that like some guys are doing like virtual inspections now.
Yeah.
And they use like your GPS coordinates to make sure you're not like showing a different house.
Yep.
Right. But that's another option too. Cool. All right. Thanks for coming. Yeah.
You may be related to zoning or permitting, but I heard that Seattle City might be changing the square footage requirement for the dados. Is that correct? Are they upping it up to 1,230?
That is a good question for Ben. I don't know off the top of my head, but okay, yes, they are. But I also know that yeah, they definitely should too, because it's a product type a lot of people don't want. But also under Seattle's new code, I think a lot of people aren't going to be building ADUs and DADUs because a new flexibility is going to allow for more of a product type that's more desirable. However, those are considered primary dwelling units, and if you have an accessory structure, you don't have to do some of the stuff that you would with a primary. It lowers your costs. So there's pluses and minuses to everything. But I think for most, the product type that people want are like 2-story, 3-bed minimum, detached, with a garage, with a yard. That's tough in Seattle, but that's just what I hear all the time. Yep. Cool. Thanks, guys.